Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 68.50 as I'm speaking. That's down about 0.5%, so about 50 basis points. About flat for the year. We've given up a little bit over the past couple of trading sessions. Small caps, Russell 2000 down by about the same amount, maybe a little bit more. They tend to be a little bit more of a risk asset, and we are seeing sort of globally risk assets sell off, largely due to the expanding conflict in the Middle East. Early Saturday morning, Israel and the United States attacked Iran, and that conflict continues to just sort of expand and spiral. It's a constantly developing story. Normally, this type of conflict doesn't really impact financial markets all that much. We've seen that in previous conflicts in the Ukraine or with Israel as an example, but this is different, largely due to the Strait of Hormuz and oil prices, effectively. So about 20 to 30% of global oil, depending on how you want to measure it, flows through the Strait of Hormuz. And that is a very narrow waterway. So it's about 20 miles wide. The shipping lanes are about 2 miles wide in each direction. And that means that it's very easy for Iran, on a relative basis, to kind of shut it down. And it's interesting, Iran has sort of noted that it is going to shut it down or, cautioned ships not to go through. The point has been made, even though they may not even be capable of shutting it, if you're the owner of an oil tanker that costs several $100 million, your willingness to effectively take that risk of, I'm going to go ahead and pass it through the strait, may be to the point where it's effectively closed, whether it's Iran telling you can't go through or you just saying maybe we'll just be anchored for a little while. Effectively, it gets to the same thing, which is oil supplies getting choked off. We've seen oil prices, they're up about 6% this morning to about $75, $76 a barrel. I've seen projections that say that depending on how long this lasts, oil prices could go up about $80 to $100 a barrel. And global oil is obviously a global commodity, so that impacts oil prices everywhere, and it is an oil price shock. Now, oil price shocks matter. Oil price shocks, if it does hang out at about $100 a barrel, should add anywhere from 6 to 0.7% to overall inflation rates. So prices get higher. Oil is consumed in a whole wide variety of things, petrochemical chain, energy prices, etc. And so that increase in the price of oil is inflationary. That's one of the reasons why you've actually seen treasuries start to sell off a little bit. The treasury yields up almost 10 basis points or 0.1% on the 10-year, as this probably means that the Fed, if they see this inflation, less likely to cut interest rates in the future due to that inflationary pressure. Although I just note most people tend to think that the Fed focuses on core inflation as opposed to energy-related inflation, but that is neither here nor there. That kind of inflationary pressure having some pressure on treasury markets. I would also just note that oil prices impact different countries and regions of the world in different ways. So the United States, as an example, we are a net exporter of petroleum products, believe it or not. And so higher oil prices for the United States, you can go back to 2015 and 2016, and that oil price fiasco, if you will. Higher oil prices for the United States generally shift economics around our economy. So things get more expensive for consumers. Things get more expensive for consumers of electricity, so manufacturing, etc. We definitely see prices rise, but that rise is then offset by a lot of people in Texas and elsewhere that we produce oil. They're really excited to see oil prices go up, and so their incremental profit or revenue, if you will, offsets the cost that we see elsewhere in our economy. And so it's kind of a net neutral for us from a macro standpoint. although you definitely can see individual winners and losers inside the U.S. That is not true internationally. So if you think about Europe, particularly Western Europe, if you think about Asia, China, Japan, these are countries that are largely reliant on imports of oil for their energy supplies. And for these countries, a rise in oil prices is much more painful because you're effectively just writing a bigger check to other sources. In fact, it's about 70-80% of the exports from the Gulf actually is destined for Asia, China, Japan, Indonesia, the Philippines, India. These countries will see depending on how long this lasts, a very dramatic negative impact from this, both in terms of rising prices, but then also in terms of just getting the oil physically itself. And that's one of the reasons why you're seeing international markets sell off much more dramatically than domestic markets. So the ACWI ex-US, which is basically a tracker of all international equity markets outside of the US, is down about 1.74%, which is materially more than US markets. I will just note that dynamic is probably likely to continue. The longer that oil is choked off, the higher prices go, the worse it gets for international markets relative to the United States. And we don't really know how this is going to escalate at this point. Iran has made the calculation. It has started to attack its neighbors, in particular, Saudi Arabia, Qatar, the UAE. It did this in the 12-day war back earlier this year, late last year. In that example, it actually had the effect of those countries coming to the United States and basically saying, hey, cut it out. We don't want a broader regional conflict here. At least early days, it seems like that calculation is going the other direction, that these countries are in effect saying like, okay, this regime just needs to go. We need more regional stability. And if we can get favorable regime change in Iran, that would be a good thing. What Iran hasn't done a lot of yet is actually attack oil infrastructure in those countries. We saw a minor attack at a refinery in Saudi Arabia. We've seen a couple examples of actually oil tankers themselves being struck. But largely, it does not appear that Iran is seeking to actually destroy the machinery that would enable these countries to resume exports. And if the only thing that we've done is shut down the Strait of Hormuz, well, that's pretty easy to open back up again once the war is theoretically over. If they shifted to attacking more oil infrastructure and actually damaging the Middle East's ability to produce oil, that would be a different story. So we will just have to see how this evolves. The administration very clearly hoping for a Venezuela-like scenario. I think, if anything, their experience in Venezuela may have emboldened them to take this step. In Venezuela, you sort of removed the leader, and even though you didn't have to get directly involved in the country's politics, you wound up with a new regime in that country that was much more willing to work with Washington and be cooperative. We'll just have to see whether or not something like that can evolve out of Iran. I think, if anything, the end game right now is very unclear how that will play out. Meanwhile, in non-Middle Eastern news, I will just note that we have a jobs report out on Friday. Most people looking for somewhere on the order of about 50,000 jobs created, maybe a slight uptick on the unemployment rate. Employment hugely important in that whole decision Fed calculus that is going on. So all eyes will be on the unemployment numbers on Friday. And then last but not least, the fourth quarter earnings season is largely done at this point. We've had about 480 companies in the S&P 500 report. They came through with EPS growth of about 12%, so net earnings per share of about 12% growth, which was better than the 9% that everyone was expecting. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. Hope you're having a great day, and I look forward to talking to you again soon.